I think it is clear to believe in the power of ideas.
Fresh thinking to the Manhattan Institute.
First of all, it's a pleasure to be here. Thank you, Manhattan Institute, for giving me the opportunity to be the moderator of this great group. My job today is to make sure that we talk about some of the issues in the report. And we're sort of the opening act for the Paul and Harvey show. And if any of you, we've certainly at Corporate Board Member had a lot of experience with these two. And I can guarantee you that you will enjoy their part of it. So, first of all, let me introduce my expert panel here. To my immediate left is Doug Chia, who's the Assistant General Counsel and Corporate Secretary for Johnson & Johnson. Welcome, Doug. Next to him is the person who I haven't met personally, but Chris, you have some of the greatest titles of anybody that I've ever heard of. And he currently is the Managing Director and Head of Contested Situations, okay, for Credit Suisse. He's formerly the Director of M&A and Proxy Fight Research for ISS. So, Chris, welcome. We'll be anxious to hear your comments. To his left is David Larcker. Those of you that are familiar in the corporate governance space know that David has been one of the key researchers. He's the James Irwin Miller Professor of Accounting at the Graduate School of Business for Stanford University and is also a professor at Stanford Law. So welcome, David. And everyone already knows James, so that is our panel. So what I'd like to do is, if we could, I'm going to throw out some questions. I really would like to leave some time for audience participation. And when we get to that, if anybody has a question, please raise your hand. The only thing I ask is when you do have that opportunity to ask a question, please take some time to introduce yourself just so we know where the question's coming from. So my first question for the panel. One of the main findings that seems to present itself throughout the report is obviously we have a small group of shareholders that are the ones that are prompting almost all the shareholder activity. My question to the panel is, should we be surprised by this, that such a select few are making such a loud noise? And I'm not sure where to start with this. I think since you heard from James, I'm going to start with Doug and work my way down the panel. So Doug, first question to you.
So the question is, should we be surprised that such a small number of individuals or firms are submitting these shareholder proposals? My answer is no, I'm not surprised. Because when you look at shareholder proposals, you got to ask yourself, well, what is the shareholder proposal actually trying to accomplish? And what's the chance that it's actually going to accomplish anything? And I think most sophisticated investors, which is the vast majority of the market out there, they've done the analysis, and they've done the analysis that is not really worth their time and resources to submit a shareholder proposal to accomplish something that probably has a very low chance of being accomplished. They could probably accomplish it by other means that are cheaper and less adversarial than the shareholder proposal route, more constructive. They probably already have existing relationships with the companies in which they hold stock. And so, at that point, you're kind of left with, well, who would file a shareholder proposal? People who really don't have the means to try to accomplish what they want, or they're trying to accomplish something that really has little to do with, their investment in the company. They're trying to accomplish other things, And for them, this might be a very cheap and efficient way to accomplish those goals. Like if you want, a page of your, basically a speech printed in a company's proxy statement mailed to 1.4 million shareholders, you spend $2,000, buy 60 shares of J&J, and you can have that. And so for them, it's a very cheap and effective way to accomplish that goal. But I think for the vast majority of investors, they've done the cost-benefit analysis, and it really just doesn't really make sense.
Yeah, I would just echo what Doug said. I think we just heard that many of these proposals receive very little support. So it stands to reason that it's going to be sort of a minority group of gadflies, so to speak, that are going to be putting forth most of these proposals, because when they do go to a vote, as we just heard, many of them don't get a significant level of support. For the proposals that do get support, say declassification of the board, et cetera, the T. Rowe Prices of the world are not going to sort of put their name behind that, although I know for personally that the firm is for declassification of boards. They're not going to take the lead and put their name in a proxy statement next to a proposal. They will certainly vote in favor of that proposal most of the time. But for various reasons, one, trying to remain relatively friendly with the corporate side, even popular proposals are not going to be sort of sponsored by quote-unquote mainstream investors.
Yeah, I pretty much agree. I mean, the history of this type of behavior is it's a small group of people that get pretty energized around an issue. I think the key part is that they seem to be more energy around these proposals. Historically, the gadflies, and I guess I'm thinking about the Gilberts in the 70s and 80s and people like that, and more recent people, it's sort of greeted with more humor. I think more serious proposals can come forward, and there's a lot of energy that gets placed on these things. But the key thing for me is always, what's the objective? Is it shareholder, stakeholder value? Does that make sense? And do they get it right? Are these just kind of religious beliefs, or are they beliefs about things that they think will really improve value? And I think that's the unknown part, and I think the report does a pretty good job at laying out some of these issues.
David and panel, my take was that these guys would sort of have an ego that goes with that would want to be in front of the audience, and certainly maybe that's true for one of them. But for the big proposal people, when we've contacted the Steiners, whatever, they really want no part of being interviewed or have anybody meet with them, and so it isn't like, I want this platform, for purposes of my own publicity. And Jim, has that been true?
Yeah, I think with the notable exception of Evelyn Davis,
right.
I mean, the other ones, they're very engaged in this, but I don't think it's a publicity thing for them. I think it is a philosophical thing for Chevedden and Steiner and Rossi and these others. And again, it's an open empirical question as to whether they're right and wrong. A number of their proposals, unlike the others, have gotten majority shareholder support. As I said, over 100 out of 350. So some shareholders, the T. Rowe Prices of the world Chris was talking about, have certainly backed some of their proposals. So it's particularly board declassification and majority voting.
Well, one of the things that also came out of the report is, which we just saw, the voting rules, special meetings, and other corporate governance sort of led the way in the proposals getting support. It was also interesting to note that the environmental and political spending disclosure, you might say, garnered some of the least support. Political spending, though, has been sort of dominated the media for a while. It's increased 20% over 2011. How, is this something that we can plan to see now year after year? Because it's a great way to have labor unions sort of target, who they feel they might like to go after, or is this phenomenon because we're in the election year? And I'll reverse the order, Jim. I'll start with you on this one.
Yeah, I think the election year has something to do with the uptick, but I do think you're going to see this as long as Citizens United is the constitutional rule. And as long as the activists pushing for it haven't gotten the Disclose Act or the sort of congressional law, which may or may not be constitutional under Citizens United, but as long as they haven't gotten that through Congress, I think this is a part and parcel of their effort. And it's important to realize this is part of a broader strategic campaign. Now, we certainly wouldn't attribute to all the folks pushing these political spending disclosure proposals the desire to get rid of all political spending, but you do see, for instance, Trillium Asset Management, one of the social investing funds, in the last 2 years, introducing both disclosure of political spending and lobbying proposals and proposals to prohibit corporate political spending. And Media Matters, the activist group, actually had a memorandum out earlier this year that said the end goal of their corporate transparency efforts are, quote, to make the case that political spending is not within the fiduciary interest of publicly traded companies and therefore should be limited. And that's a pretty bold claim. There are a few studies that have shown some negative stock effects of corporate political spending. They're outlier minority studies, as we outlined in a recent report with Robert Shapiro and Doug Dowson, who are Rob is a former Clinton administration official and a co-founder of the Progressive Policy Institute. So these aren't right-wing people. They're sophisticated econometric types of people looking at these analyses. And I think there's some methodological problems with those studies. But clearly there's times when companies may spend politically in an unwise fashion. The question is whether that's traditionally as traditionally thought to be under the business judgment rule, we're going to leave that to the manager, or if we want to have shareholders voting on all these sorts of things. But to the broad question, I think this stuff is here to stay as long as the rule of law is what it is today.
Yeah, TK, I would agree with Jim that this is here to stay. But I think the volume of the number of proposals that we're going to see over time on this issue will probably plateau. I think this year's a spike because the election is front and center. It's top of mind. But I think in the future it'll plateau, and probably the level of support will level out in somewhere in the 20s, like we've seen. And I think part of that is because you're right. This is really a Citizens United reaction type proposal. And the theory here for the Citizens United, the rabid crowd is saying, well, we need to submit these proposals because public companies are buying our politicians. The stats don't really bear that out. I mean, if you look at most of the large companies, they don't make the kind of contributions that Citizens United permitted. If you look at the public disclosures that have been required after Citizens United, the big contributions to these super PACs and these other things that people are saying really are playing an undue role in our election, they're funded by very rich individuals, but not public corporations. Sometimes private corporations, but the Johnson & Johnsons and Goldman Sachs of the world, these are not the companies that you see at the top of these lists. And I think most of the sophisticated investors realize that, and so they say, there's really no merit to this proposal. There's some other agenda being pushed here that really doesn't have anything to do with public companies. It definitely doesn't have to do with the specific public company where these proposals are being submitted, and that's why these things don't get support.
Chris and David, is this the kind of situation that the activists would hope that they can get enough companies to flip even without the vote, to where all of a sudden the use of that becomes a valuable tool so that if these companies do it, and all of a sudden it's much harder for the rest of the companies to say we're not going to do it?
Yeah, I think, clearly. I mean, it's a game. One of the things about the voting is most of these don't pass. That is 51%. But I can assure you, when you're working with boards, that you get 15, 20% votes against you. That gets on your radar screen. You start debating that. You start making changes and thinking about that. So I think the political contribution aspect, I think it's a good topic, but I think the angst that's out there regarding governance and compensation, I think there's other easier avenues to express this. And I think some of it has occurred through say on pay and other things that are easier to do. To Doug's point, I think I'd caution us a little bit of trying to make these direct correlations. I mean, a network of contributions and who influences what companies and things like that, it's a murky web. So it's a very difficult study to do. I think it is true the preponderance of studies have shown if you have political connections, those companies do better in terms of stock return. That said, there's two ways you can do better. One, I think, is probably desirable, and one is undesirable. And I think it remains to be seen whether you can disentangle that or not.
Yeah, the only thing I would add is I don't think there's broad level support for these proposals, even if they get support in the 20% range. I think the proposals sort of fall into the bucket, and I can come back to this later, but where I think ISS is particularly influential because in my experience dealing with the mainstream investors, this is the type of proposal that many mainstream investors won't spend a lot of time thinking about. And the less time they spend thinking about a proposal, the more likely they're going to defer to the ISS recommendation. And ISS has come out, I think we just heard, sort of in favor of most of these political spending proposals. So is there truly support in the mainstream investor community for these proposals? I'm not convinced.
Okay, well, it's tough to have a panel on a topic like this without talking about the ISS, and I think Chris, I'll save you for last here because I'd be curious as you walk both sides of the fence. But one could interpret from the report that the ISS maybe doesn't have the best of handles on what the rank and file shareholder cares about. James's analysis provided statistics that the ISS supports over 63% of the proposals, where a majority of the shareholders support less than 8%. That may be part of their, that may be not very strange to them, but this is the kind of thing that becomes great fodder to the ISS bashers, So my question to the group, and David, I'll start with you on this one. What should we decipher from the numbers and the synopsis from ISS and shareholder activism out of this report?
The ISS Glass Lewis proxy advisory industry is certainly one that we at the Rock Center at Stanford have spent a lot of time researching. I guess I apologize to Chris; he's heard this diatribe before. We've been pretty harsh critics about ISS, and our view is that we view ISS and Glass Lewis professional organization. They're serious people. There's a lot of whining about they do consulting. There's a lot of whining about they make mistakes. I view that as not a good path to go down. I think the real issue is they're making recommendations based on research. Are those recommendations good or bad? And some of the stuff that's in your material, you can certainly check our website out. We basically find that the recommendations that ISS Glass Lewis make decrease shareholder value as opposed to increase it. One example being, say on pay, companies that look like it's going to be kind of ticklish on the vote. You see them making major changes in their incentive plans ahead of the vote. When these are disclosed at the 8Ks, you see the stock prices of those companies go down. And admittedly, like all studies, there are limitations. I encourage you to take a look at these studies. Happy to respond or interact with you on this. The ISS Glass Lewis kind of view a little bit is 20 is the new 50. If you get 20% against, it's almost like you failed the vote. I think in America we typically don't count that way. And so you're doing things there where companies are really respond to these, what I consider to be largely arbitrary recommendations. And I think it's very serious. We've actually done a lot of work on the voting. It's actually worse than what the report suggests. It's at least 30% swing when you get a negative ISS recommendation. So I think this is a serious topic. That said, I think there's a demand for organizations like proxy advisory companies. There's a large fixed cost in collecting this data. You want expert opinions. Most mutual funds, in truth, do not have permanent proxy voting groups, and I think there's a demand if they get it right. And I think that's the key thing. Are the recommendations appropriate? are the shareholder value increasing or not?
Yeah, I think the couple things that we can decipher from the numbers about ISS, and I'm not an ISS basher. I think, look, ISS, they've got a great business model, and they've got a dominant market share, and they're trying to make money. Their creation, basically, there's law and regulation that created this cottage industry, and they're the biggest cottage on the block. And so, I don't begrudge them for being the way they are. I think, the two things that, I would say, we can decipher from ISS and the stats that are shown in the report are that, one, ISS is the leading proponent of the shareholder primacy theory. If you look, I don't think I disagree with David respectfully that, I don't think their decisions are arbitrary. I think if you look down the line at what they're supporting, they are supporting anything that will shift the power of the corporation from the board or the management to the shareholder, for better or for worse. And so that's really what they're pushing. And when they're not pushing that, they're really pushing the interest of their client base. If you look at their client base, they have a lot of clients who care about labor issues and environmental issues. They don't have that many clients that care about animal rights issues or religious issues. And so I think the numbers bear that out. So it's really, they are pushing shareholder primacy because that's kind of philosophically what they've bought into. And they're also pushing the interests of their clients, which I guess you would expect them to. That's their client base.
Before Chris goes, I just want to say I agree with Doug completely. But in terms of them having a great business model, I think it's just important to point out. I mean, this is a company that last year, and we know this because it's owned by a public corporation. I mean, this is a company that last year had just over $11 million in profit and $119 million in revenue. This is not a huge company. I mean, I think it's an open question as to whether ISS gets it right or wrong. We know that they're systematically more in favor of these shareholder proposals and systematically more against executive pay than shareholders are on average. And so then the question is this company with 600 employees and $120 million odd in revenues more likely getting it right or wrong, or all the investors with trillions of dollars in assets more likely getting it right and wrong? And I think it also sheds light on how much investors with their own money at stake value information when it comes to these sort of shareholder voting decisions. Going back to the first question, there's only $120 million that the dominant 61% market share player here is getting in revenue, and 20% of that is consulting with corporations. So really only $100 million that they're getting in revenue annually.
Well, but I would say that, that just means that they can manage better and make more profits in terms of, I think it is a good business model, and they're the dominant market. They're the dominant player out there. But to your point, in terms of whether they get it right or wrong, their business model has nothing to do with whether they get it right or wrong. There is no right or wrong for ISS or for their clients. The only right or wrong is if you vote or you don't vote. The law says voting is the right, not voting is wrong. Hire someone. If you can't think for yourself, hire someone else to do it. That's permissible under the law, and that's where ISS and Glass Lewis and this whole cottage industry comes in. You pay them. They can vote yes, no, or abstain, and you fulfilled your requirement. So that's the crux of the problem, that right or wrong doesn't matter in this game. It's just whether you vote. You're supposed to vote. You can hire a monkey to do it, and if a monkey is cheap enough, someone will do it.
Wow.
Well, with that introduction, Chris, I'd be anxious to hear your views.
Yeah, no, a lot of great stuff there, and I think I agree with a lot of it. I spent about 7 years at ISS. Now, I ran the team that analyzed mergers and proxy fights for board seats, so I really didn't spend a lot of time on precatory proposals, but I obviously witnessed sort of what went on internally. The numbers to me are, astonishing. I know personally from my perspective, my corner of the world, if there was that much divergence between, if there had been that much divergence between outcomes and my team's recommendations on mergers and proxy fights, I would have been a little uncomfortable and probably, definitely would have adjusted my approach to those issues. Because after all, you're supposed to be serving your clients, and if your clients are way over here and you're way over here, I don't think you're doing them a service. I think overall, I think the dynamic internally there is very much as Doug described it. I think it stands to reason. If you're called institutional shareholder services, you're going to drift towards the shareholder primacy model, and sort of have, whether it's conscious or even subconscious, sort of bias towards shifting power to shareholders and away from boards. I also, wanted to note that ISS, after I joined, began doing much more of an outreach in the fall as far as policy development, which sounds good because before I got there, they really weren't even talking to their clients about developing policies. So they started this off-season sort of, they'd send out a survey. They'd have off-site meetings with key clients, et cetera. But like anything else in life, the squeaky wheel gets the grease, right? And the folks that are most active, in my experience, at least when I was there in that process, are the more sort of radical or aggressive shareholders who would be more supportive of coming down harder on pay or in support of some of these social environmental issues. And the mainstream investors tend to participate, not participate or just participate at a much less sort of lower level of intensity. And therefore you've got policy that's being driven by a small group, subset of investors. And then that policy is rolled out to the next season. And then I think you end up with the numbers that we heard this morning. And frankly, at the end of the day, does that matter? Getting then back to Doug, I guess maybe it doesn't in some cases, particularly with non-economic proposals, where there seems to be the greatest divergence between ISS recommendations and outcomes, because either people aren't following that recommendation because it's out of the mainstream, and to the level it is followed, it's because there's sort of a built-in demand to outsource voting and recommendations, and they're not giving any thought, and they're just saying, I don't care, it's a precatory resolution, it's non-economic, we'll just do whatever ISS says and satisfy our regulatory duties.
Yeah, I think that's an important distinction to make. Obviously, Chris was running a part of ISS that is a lot different than what we're talking about. We're talking about shareholder proposals that are precatory by and large. Chris was running the M&A piece where you have contested elections where, the outcome will affect the value of your investment. And so I think we definitely need to separate those sides of the house.
Let me push on it a little bit. I mean, they're not all precatory.
Right.
And I agree with Chris. I think, I'll paraphrase for him, I think you do get more or less the A-team at ISS when you have a big liquidity event. And so I think you want to be pretty clear about that. But something like stock option exchanges or repricings and things like that, I mean, if the officers and directors participated in that, you're going to get almost certainly an against recommendation. I can assure you that that's not good from economic value creation. And we've looked at that in detail. And that would be an example where I think, even though, when I say arbitrary, I mean they haven't done any research to back it up. They clearly are not arbitrary in the sense that there's some kind of rules that they're going through. But I think what's missing in this is that there isn't enough research around this saying, is it good or bad? And as the panelists have said, I absolutely agree that, most mutual funds, most big institutional investors, they're trying to do the vote at the cheapest way, particularly if they're big index funds and things like that. And so you've got this sort of weird combination of events. You have to do the vote. You don't want to spend the money to do it. An organization comes and shares the fixed cost across a bunch of people. They have recommendations. You vote. You've satisfied your fiduciary duty. From the other side of the fence, when boards start getting 15, 20% votes against, they start making changes. It sucks up board time. And I think the debate is that a good or bad use of time? And my instinct, it's not a good use of time. On the other hand, I mean, it's an empirical question that I think deserves research.
Yeah, I mean, I 2 points, great points there, David. On pay, which I didn't directly address, I think the whole say on pay is even a third bucket. We've got M&A and then we've got precatory sort of general governance proposals, and then we have say and pay. And now I'm on the corporate side now, and certainly our clients that, as David said, there's maybe a 20-25% against vote on a say on pay proposal. That gets the attention of the board and management team. So pay is also sort of a third bucket that's sort of in between the two. I think one of the problems, David, you published work on that these proposals do have an economic impact. I'm not quite sure that the average investor out there is aware of that, right? And I think if they were aware of it, that this was actually going to affect their bottom line and affect their performance against their benchmark and therefore their bonus at the end of the year, they would be taking it a lot more seriously. But I think the general consensus out there, even on pay issues, is they shrug their shoulders and go, whatever, it's not going to have a huge impact. And I think that's short-sighted.
Well, I'm going to regain control here of the panel. And there's no question in my mind that we could go at least 3 days on ISS alone. So I want to get back to the report because I do want to leave just a little time for Q&A. James, I'll start with you on this one. Back to the report. What is the solution to the problems associated with the use, or we might say abuse, of the shareholder proposal process by activists to further agendas sort of unrelated to the corporate value, sort of the issue we hit on here? So,
I think the number one thing you could do with these sort of what are called precatory, or sort of, the proposals that are non-binding, that often have to do with these sort of social policy issues, needs to be a legal challenge, and really you've got to get the DC Circuit to revisit its opinion back from the 60s in the Vietnam era, where they said, oh, these are things of general policy concern, we can put them on the ballot. I really think they ought to be under the business judgment rule, the long-standing corporate governance rule that's the rule in Delaware. I don't think they have any place on the ballot, and I think they ought to be generally excluded under the SEC's 14A8 process, but that's not going to happen without a DC Circuit shift in its long-standing precedent. I actually think, depending on the panel you draw, or if you went on bank, I think you'd have a pretty good chance of getting the DC Circuit to take that stand. Beyond that, I think, just for the shareholder voting proposals process more broadly, I think there needs to be a serious reexamination of what Doug is accurately describing as the regulatory imperative to push all these funds to cast votes in these elections. I mean, this isn't something that they do because they choose to do it as benefiting their investment strategy. They're doing it because in the case of pension funds, the Department of Labor, and then in the case of other institutional investors, the SEC, for the last 25 years or so, has said you have to do it, and it's part of your fiduciary duty. I think clearly if all they're going to be doing is outsourcing this to a company like ISS that may have systemic bias in its recommendations, there's a question as to whether they should be voting at all in these sorts of cases. And similarly, the New York Stock Exchange may want to rethink its broker non-vote position that it recently shifted with SEC approval 2 years ago in contested director elections. I mean, all these sorts of shifts, what you've got is a regulatory mandate here for these folks to vote in it, and that creates the demand. And so I think, on the one hand, you could get the federal regulators to shift voting requirements and whatnot. On the other hand, I think lawyers ought to creatively come up with the right case and say, we're going to take this back to the DC Circuit and try to get them to re-examine their opinion.
David?
Yeah, I think the proxy access, I guess I'd call it a debacle. I mean, I'm sort of glad that it didn't go through. I just can't imagine how that's a good outcome. I think that we are generally against kind of the federalization of governance. We think it ought to operate in a market setting, but what should be on 14A8 and things like that. I think it's really a matter of law, and I guess I'm going to pass it over to the lawyers.
Okay. I'm recovering.
There are a couple things in terms of what the solution is here. There are a couple things that could help that could be done by the SEC without too much effort. There would be some commotion, but one is raise the ownership threshold. Jim alluded to the fact that all you need is $2,000 and a dream, and you've got yourself a shareholder proposal. $2,000 is ridiculous. Yeah, like it's less than 100 shares of J&J, which has 2.7 billion shares outstanding. So, there's one thing they could do there. Raise the resubmission threshold. People submit the same proposal year after year that get votes in the single digits, even if they get votes in the teens. After a couple years, look, your proposal, nice proposal, it lost. You have to go away for maybe 5 years. Apply some kind of cooling off period if you have a serial loser on your hand. I agree with Jim in terms of the Avon letter and its progeny. Tear it up. That is what is forcing everyone to vote. The only governments, the only regimes out there in the world that require people to vote are totalitarian regimes. The United States, only less than 50% of the people will vote in November. And to me, that's a good thing, because those are 50% of people I don't want voting, because they have not taken the time or energy to educate themselves to vote. So please stay home on November 5th. Don't vote. And the same should apply to investors. But if you're going to make them vote, then enforce this whole fiduciary duty obligation. Turn the spotlight back on the investors. I think, ISS, they're allowed to think whatever they want. They're allowed to tell people how to vote. That it's a free country. But the investors, they're the ones who are being, lazy, foolish, cheap, whatever you want to call it, and they're not spending the time to really figure out what the correct vote is when the law says that you have an obligation to vote because the vote has some kind of a value on there. Meanwhile, you have the Department of Labor in a letter that's in your book saying, well, the vote really doesn't have very much value, so we're not going to enforce this stuff. Make up your mind. Either get rid of this requirement or enforce it. And if you want to hear my real opinions, we can talk afterwards.
Chris?
Yeah, I don't have anything to add. Actually, those were the 3 points I was going to make. The initial threshold should be raised. Resubmission threshold should be raised. You shouldn't have to lose and lose and lose every year. And the last point, very resonant to me, having worked at ISS, because we got a lot of criticism of ISS, and a lot of times my answer to that when I was at ISS was, well, you know what? It's the clients of ISS that are driving it. They're the ones following the recommendation. If you have a real problem with the ISS recommendation and people voting that way, go after your shareholders who are, in effect, sort of delegating their fiduciary duties blindly. And so I agree with that viewpoint as well.
We have time for like one or two questions. I'm very curious to see what the opinion is of the audience. Does anybody, while we have this crackerjack panel up here, anybody have any questions relative to the report or what we covered? No, this is taped, so this is going to be, I'm probably doing something that's awkward here by turning this around, but go ahead in the back and I'll try and...
Thank you. This is really a question for Chris. My name's Aaron Elstein, and I'm a reporter with Crane's New York Business, and we've had a situation for several years where the big banks are trading for less than book value. That seems like a classic, recipe for shareholder activism. We haven't really seen anything that I can think of, and I'm wondering why you think that is.
Just my opinion. My opinion is that an activist, the activists that I know anyway, really do their homework and do due diligence on the companies in which they invest if they're going to allocate hundreds of millions of dollars. And right now, I think it continues. It particularly was the case in the last couple of years. If you talk to activists, they don't quite know if they understand the bank's balance sheets, right? Like everyone else. And so if you don't quite know if the book value number is real, you're not going to sort of jump in and catch a falling knife. That's my view.
Got time for one more question before I give these guys sort of a closing. Not seeing one, we'll go ahead. Each of you have about 45 seconds to a minute for this summary, and I'm going to start with you, James, at the end. Certainly, we've seen since the financial crisis that the skids are greased, okay, for things like shareholder support and shareholder proposals. We had a big blip in the road with the legal defeat of Proxy Access. But I think that the environment's sort of still there. I'm not sure that corporations and boards of directors have the greatest, reputation right now. So it's easier to get sometimes, it seems like, shareholder support. But my question to the panel is, what do you believe will be the tone in the immediate years ahead with respect to all these shareholder proposals and shareholder activism?
Well, as a general matter, I think, TK, you're right. There's a lot of sort of suspicion of boards and management, and so I think it's going to continue to be an issue. I think, obviously, who's running the administrative agencies in Washington makes a big difference in terms of how that is going to play out. And it's important that the laws shift as well. So in reaction to the two big events, the bubble bursting and then the financial market collapse, we saw Sarbanes-Oxley and then Dodd-Frank. That's a big impact on this process and substantial shift toward federalization of corporate governance issues. Those things could reverse themselves, but I don't see a lot of political movement in that direction. So I think we're going to have this as the new normal, at least for the time being.
I think it's going to become increasingly aggressive. Although, for those of you who have studied this, we know that exec comp and governance issues become more of an issue when the market's flat or going down. When the market's booming, it's less of an issue. I mean, you can look back over time. It's going to depend a lot on what the market does. I mean, my sense is boards, by and large, are trying to do the right thing. It's a tough job. Are there some bad guys out there? Sure. But I don't view it as pervasive in the economy. And just as I wanted to compliment Manhattan Institute. I thought the report was great. I think it's time to move beyond. Let's get a bunch of smart people and have another blue ribbon panel about corporate governance and executive pay. Let's actually bring some data together. Let's get some facts so that we can focus the debate. And I compliment the Institute for putting together the report.
Chris?
Yeah, in my view, a couple of trends that we're seeing is a continued move towards short-termism. And I think that's driven a lot by these shareholder proposals and activism in general. So you have continued dismantling of takeover defenses, for example, which puts companies vulnerable to sort of short-term pressure. You have annual say on pay, which has boards and management teams, sort of every year having to go through this process and placate, one or two shareholders that might be unhappy. So overall, I think that creates more of a focus on the short term rather than investing for the long term. On the positive side, and we've talked a lot about this at the Stanford Institute, is say on pay has forced companies to engage with their shareholders more frequently, initially on pay, but by all accounts, anecdotally, what we're hearing are those discussions then evolve into engagement on actual, sort of strategy and what the company does for a living. And I think that's a net positive if you're trying to attract and retain long-term capital.
Doug?
Yeah, I mean, I think we're going to see some pressure on the proxy advisory industry from the SEC and from others to make some kind of reforms. But I think that, I think like David was saying, unfortunately, a lot of that just kind of devolves into the whining over very kind of small things that don't make that much of a difference. And hopefully that won't be too much of a distraction. I still feel, as I said before, that really, there's too much focus on the proxy advisory firms and shareholder proposals and not enough focus on the investors and how they are actually making these voting decisions and whether these voting decisions actually do have any value in terms of which way people vote. And so unfortunately I think that the focus on the proxy advisory services, which will happen, is going to really kind of detract from the larger philosophical issue, and then the even larger philosophical issue, which Chris was talking about in terms of short-termism versus long-termism, and how can we make structural changes in the markets and the regulation to set us on the right course.
Well, I was hoping that Harvey and Paul would touch on the proxy advisory accountability, but you make a good point there, Doug. That's our time, and I'd like to thank James, David, Chris, and Doug for a great job as a panel. And thank you Manhattan Institute for a great job, and we will turn it over to the main act.
I think it is clear how fortunate we are to believe in the power of ideas.
Supply the common sense and the fresh thinking of the Manhattan Institute.